Good afternoon, everyone. Today is Wednesday, and it's the midweek update for the One Rental at a Time. Zuber's not with me, so I'm doing this on my own today. Um, what a difference a week makes, huh? We're going to take a look at some charts, but the market finally rolled over and started its decline. As I have been saying, it's probably going to do that in July. And right now it's about 440. So market's closed. That's on the East Coast. So the market's closed here. Um, I'll show you what happened today. But I would like to remind everybody that on Sunday, when I did the update, um, I mentioned that the market probably would have a reaction rally, which is what happened Monday and Tuesday of this week. And I gave you some things to look for. It didn't rally as much as I thought it might, but it rallied a little bit. Monday for sure. And that looked like it was going to bounce. And then Tuesday, it rallied a little bit and then gave some of that back. And that was a prelude to today. So basically started down this morning and just continued to go down. So let me share my screen and we'll see what's going on. I had a nice email from a subscriber saying, thanks for all of the analysis. He said he went to cash yesterday because of what I was saying about July. And the note, he sent me the email today and he said, I'm so glad that I did. So it's worth looking at history and seeing, historically what the market has typically done. There's a saying by Dr. David Paul, who passed away last year, unfortunately, but a fantastic trader that I learned a lot from. He said, beware the July high. And I would have to agree with that. So here is my website, breakpointtrading.net. If you're interested, free newsletter is right here. I put that out every weekend just to do a recap of what happened during the week and some of the historical information and economic information as well, and some funny cartoons. So if you're interested, there's no charge for that. So a lot of the content that we're going to look at today is for subscribers. So if you subscribe, it's only $99 for a year. So it's not very expensive. Like one person said, it's the price I pay for a nice dinner with my wife, but the value and the content you get is incredible. To sign up for the newsletter, you can just click on this one. It's no cost, doesn't ask for a credit card, but you'll get a reminder. You can do a monthly, which gives you a 7-day free trial if you just want to check it out. Do that one if you don't think it makes sense for you. And the way I view this is it's a toolbox that can be used to trade either short-term, long-term, whatever kind of trader you are. There's information for everybody in here, but it's basically a toolbox that you can use to help you make your decisions. And then if you like what you saw with the 7-day free trial, you can either just continue on a month-to-month, or you can go to the 1 year, whatever you like. So first thing I want to show, and something that I showed on Sunday, but we'll see how it's ended up. This is the market. This is the S&P and all of the 10 sectors underneath it. So the red dash line across here is Monday's open. So you can see Monday, we actually closed higher. Tuesday, we kind of went sideways, closed a little bit lower. And then today, gap down at the open and never looked back, just continued to go down. A lot of this, I think, was based on Tesla's earnings and maybe even Google. But there's a lot more earnings coming up here soon. So we'll see how that's going to affect things. But what I want you to notice is on the left-hand side, these are the aggressive sectors primarily. On the right-hand side are mostly the defensive sectors. So notice what the trend looks like. Financials had a good day, and financials are going to continue, I think, to do well, especially if the Fed does cut rates in September. They have a meeting next week, but no one's expecting them to cut. If they do cut, it's going to be a surprise to the market on the 31st, and the market will take off if that happens. But no one's expecting that, and I don't think they're going to do that, although there's plenty of evidence that they should. but they probably won't. They'll probably wait for September. So financials are doing really well. Discretionary technology, discretionary communication services. This is where the internet stocks are. Those are the three main aggressive sectors. Technology is lower than Monday. Discretionary is lower. That's where Tesla resides and Amazon. Communication services, that's where Google is also lower. Industrials actually is a little bit higher, did pretty well. But on the defensive side, healthcare did real well. Staples did really well. Staples and utilities are the main defensive sectors. Utilities did great. Energy came back to where it started on Monday, but it rallied a little bit today. And then materials, which is where gold is, also rallied today. So you can see just by looking at this, the market is in a very defensive stance right now. In fact, a lot of the money that has been rotating out of technology, you can see technology makes up almost 31% of the S&P. A lot of that money that's been rotating out has been going other places. It hasn't been going to cash. It's been going to other things like defensive sectors or like the Russell 2000 small caps. And we'll take a look at that. The other thing I want to show is the VIX, so the fear index. I talked about this on Sunday as well, how it looked like it was starting to ramp up. And you can see today it took off again. The VIX on Friday, this was options expiration, so lots of volatility as always on options expiration. And then the VIX kind of pulled back a little bit Monday and Tuesday as the market was climbing slightly. But today the VIX took off and is now in between the 17 and 20 area. So anything below 17, the bulls are in control. Anything above 20, the bears are in control. And if it gets above 20, then it will absolutely continue to move lower. Right now, we're kind of in this no man zone. So it could go either way. And a lot of that, I think, will be dependent on earnings the next few weeks. We'll look at what earnings are coming up in a minute. But you can see the trend for the VIX has been basically sideways, down to sideways until just the last week when it's been starting to ramp up. Here's a 12-month rate of change. Again, this very clearly shows you, and it actually started, last week. I pointed it out last week that it was just beginning, but now it's ramping up pretty dramatically. And you can see the moving averages here that kind of give you a sense for what the overall trend is. And right now, the faster moving average is above the slower one. So that means it probably will continue going up. We'll see if it gets to 20. The correlation down here, I pointed this out too. When it's above the zero line, that means they are correlated, meaning the VIX and the S&P are moving together in the same direction. That does not happen very often. Normally, they are inversely correlated. When the VIX goes up, the S&P goes down. When the VIX goes down, the S&P goes up. But they were correlated for a brief period, and I pointed out that whenever that happens, that means the S&P is probably getting ready to roll over. So that gave us advance warning last week that this was coming. And there's been lots of warnings, and I've talked about it many times on this channel. Many warnings that July is usually the middle of July is when the market starts to move down and may continue that until October. There's a saying from Dr. David Paul, great trader who passed away, beware the July high. So there's the VIX. The VIX is continuing to give us signs that the market is probably going to continue to go down. Let's take a look at what the actually indexes look like. Actually, I'll do that with the trend model. So I'm going to step through all the trend models because we can talk about what things look like. So the trend model, this is what it looks like. I've got one for indexes, sectors, and one for the Magnificent Seven, plus friends. And anything that's highlighted in yellow means it just changed this week. So you can see the short-term trend right here is the pink one. The blue one is medium-term, and the red one is long-term. And you can see the S&P just got a short-term down signal. Magnificent Seven, short-term down. Bonds, short-term down. Interestingly, Bitcoin has just got a medium-term up, and Bitcoin's actually been doing pretty well. I'm going to step through each of these. 10-year Treasury is also heading down. It's now in a long-term downtrend as of this week. So it's short, medium, and long-term. 10-year Treasury is headed down. And here you can see the VIX. The VIX has been heading up. July 11th, July 17th, medium-term up. It's still in a long-term down signal. but we'll see how long that lasts. The other ones, the sectors, we'll look at each of the charts here in a second. So here's the sectors. Technology and communication services both got a short-term down last week, and discretionary got it today. This is where Tesla is. Tesla contributed a lot to that. Materials, interestingly, which is gold, got a medium-term up signal today. So that's interesting. And then the Magnificent Seven, you can see here last week, a lot of these got down signals. Two of them that got medium-term down are AMD and SMCI. Both this week got medium-term down signals, but they all got short-term down signals last week. So let's go back and step through each one of these, and you'll get a sense for what these look like, what the market looks like, and why I have been saying that, you know, the market's ready to roll over. Be careful, go to cash, protect your profits, move your stops up. Use leverage or hedging if you want to. This is probably not over. I think it's going to be volatile depending on earnings. It could bounce up and down, but in general, I think it's headed down. So normally the way this works is the short-term signal triggers first, and then the medium-term signal triggers next. So the medium-term, this would have to move down here to cross this red line down here. Now, the price is sitting right on that red line. It's the 50-day moving average, and that is a key support level. So for the S&P, price is sitting right at the 50-day, which is key support. It won't give a medium-term signal until the 21-day. This blue one comes down and crosses over. So the price could actually be much lower than that when that medium-term signal happens. You can see right here where it happened. So this didn't last very long, this period, and then we were back into the uptrend again. That could happen again, but based on the way that these momentum indicators look, you can see this one here rolled over right back here on this first down day. So if you were just following that, you would have been out real early. This one here is a longer term trend signal, and this one just crossed here today. So this one will take some time to come back up. You can see back here, it went down right here, just about where the short-term signal was, and it came back up right about where the short-term up signal was. So this is a daily chart. So that's about 2.5, 3 weeks right there. I think this was going to last longer. I think this one might last until October with some up moves in between. So keep an eye. The trend models will kind of signal when that's going to happen. So there's the S&P. Here's the NASDAQ, which actually went below the 50-day. So it looks even worse than the S&P. And this is where most of the big cap tech stocks are. You can see the my cold is getting better, by the way. It's not 100%, so, but I'm getting back finally. The longer term signal is really diving significantly. That's going to take some time for that to come back again. So that's why I think we're in for a couple of months of a down market. The Dow Jones looks a little bit better, actually. So it's just sitting right on the 21-day, and these haven't crossed yet, but they're just about to. The Russell 2000 small caps actually held in there better than anything. And small caps, I think, especially when the Fed cuts, and you can see where the short-term signal right here, and we got a parabolic move right after that. The medium-term signal just 2 days later. But if you had just been watching the short-term signal, got in right there. This, by the way, was the day before the CPI number. The day of the CPI number, Russell 2000 took off because a lot of these small caps are very dependent on lower rates. So that's why this is holding in there really well. And this is probably where a lot of the money is rotating to. I mentioned the rotation to defensive sectors, but the rotation is also into small cap stocks as well. Magnificent Seven got a short-term down signal today, closed below the 50-day. And you can see the momentum indicators are rolling over significantly. The MACD up here actually rolled over right after this big red candle, and it tried to make a recovery. Couldn't quite do it, and this actually rolled over anyway, even with the recovery. So that would have been the early signal that the market was headed lower. Bitcoin actually looks pretty good. Bitcoin gave a short-term up, and it gave a medium-term up signal today. Now, it is declining the last couple of days. So we'll see if it can hang in there. But Bitcoin is one of the areas that actually is doing pretty well. Gold also has been doing pretty well. Gold is pulling back right here, but it's not anywhere near what the other ones look like. You can see the momentum indicator just starting to turn right here. But the one down the bottom, the longer term one, is still going to take some time. So gold is hanging in there pretty well. Treasury or bonds, actually bonds followed the rest of the market today and started heading down. It gave a short-term down signal. It's been very volatile the last couple of weeks. That actually gave a long-term. This is the red one right here. You don't see this on most of the charts because it's so far back, but this one here actually gave a long-term up signal back here in June. But it's just oscillating back and forth. And I think bonds are going to do this until the Fed gives us a clear direction, which they haven't really done yet. 10-year Treasury was headed lower. It's now pulling back a little bit. It gave a long-term down signal right here, but you can see the momentum indicators actually imply that the 10-year Treasury might be creeping back up again. So we'll keep an eye on that too. Here's the VIX that I talked about before, and you can see the VIX is up here at 18 right now, close a little bit above 18. So it's continuing to go higher. Next is I'll go through these pretty quickly. These are the sectors. So there's technology, obviously, taking a big hit. These are ETFs, by the way, so you can play the whole sector if you want to, just by buying or selling short that ETF. Here's communication services. This is where Google is. We'll look at Tesla and Google in a minute. Here's discretionary, big hit on discretionary. Most of that is as a result of Tesla. Staples, hanging in there actually. Staples is a defensive sector. Utilities is a defensive sector, actually went up today. Healthcare is also defensive, actually went up pretty nicely today. Energy, sort of going sideways. This will give a short-term down signal tomorrow. If it goes down or even just stays where it's at, it will get a short-term down signal tomorrow. Materials actually sold off today, but in general, it gave a medium-term up, but it's just kind of hanging out, going sideways, along with gold. Industrials also sold off today, but it's still looking fairly strong compared to the rest. There's financials. Financials is one of the better looking sectors, and real estate too. Real estate looks pretty good, which you would expect when lower rates are coming. So here's Google. Google reported yesterday, and I think they beat their numbers, but I think they guided lower, and I think that's going to be the trend in a lot of the earnings that are coming up. I think the earnings might be okay, but the guidance is what everyone's going to be listening for. So I think they guided lower. So that one is sold off today. And it still looks like, I mean, you can look at the momentum indicators. It looks like it's going to continue. The volume was huge. So Google may continue down. Amazon, that reports on August 1st. Amazon is in the discretionary. You can see over here is the sector. So it's in the same one as Tesla. It is still heading down today. Here's Apple. Apple will probably get a short-term down signal tomorrow or the next day if it continues lower, and momentum indicators look like it will. Here's Meta, also took a hit today. It's reporting on the 31st next week. So it's kind of following along with the other big cap tech names. Microsoft, also a huge hit today. Of course, the issues last week with Microsoft and CrowdStrike is not helping Microsoft much. It gave a short-term signal, by the way, last week. So if you were just watching these charts and you see the rollover right here in momentum, this will be the first signal. So you can either just get out on that signal, which you would have got out right here, or you can use it as a heads up that to watch the next signal, which is the short-term signal right here. And as this continued to go down, it gave you advance warning that this was probably going to give a short-term signal. So you don't have to actually wait for the signal. You can see how things are trending. And you can see that that was coming. So the medium-term signal still has to go down a ways. It's got to go, you know, the blue line has to come down here to the red line, which means the price either has to go sideways or down some more and that'll happen probably next week sometime. So that's Microsoft. Here's NVIDIA. NVIDIA also broke below its support line, and it broke below the 50-day moving average. Neither one of those is a good thing for NVIDIA. Now, on NVIDIA, I'm going to annotate this chart. And there is an open gap right here. And here, that's the top of the gap. Here's the bottom of the gap. Here's another gap right here. Right about there. And the bottom of the gap right there, which is also where the highs were back here. So that's the thing to watch for. 110 is the next support level. Below that is about 106. Below that is about 102. And then we go all the way down to 95. 95 is a pretty solid support level. So I think that one will hold. But I have my doubts about the 110 level. I think the 105 level probably is where we're headed right now. If you look at consolidation theory and you take, let's see, let me get rid of this. And if you take the high, this high right here, which is at about 135, and you take the middle of the consolidation, which is at about 121, so that's 14 points. So 121 minus 14 takes us to what? 111, 107. Takes us right down here, 107, which is the top of this gap right here. So that, I think, is the target. I think that's where NVIDIA probably is headed to. For those that have been waiting to get into NVIDIA or would like to add, like me, that actually might be a really good thing if it gets to that point. Because if it does get down there, I'm probably going to add. You can see that the earnings date is 8/28, and it usually starts moving up into earnings about 3 weeks before that. So that's about the first week of August, which is the week after next. So NVIDIA could continue down, get down here to this level, even could get down to 95 or 100, could just move sideways for the next 2 weeks, and then start its run back up again. So we'll see. We'll keep an eye on that. Tesla. Here's Tesla. Again, Tesla reported yesterday, last night. Market didn't like it, sold off all day long and ended near the low. So this will probably continue selling. It'll probably go down to the 200-day moving average at 205. And then we'll see, and the rising 50-day is going to be right about 205 as well pretty soon. So 205 area is a very critical, important test for Tesla. It needs to hold there. If it doesn't, it probably is going to go much lower than that. I showed on Sunday with Tesla back here, going back a couple of years, and I had talked about this. I talked about it on the Zoom call that I do with subscribers, that this area right here at about 260 is where all of these folks and these folks had bought, and they're just waiting to get back to break even. And that's what happened. Got to break even. They started selling, not heavily selling, but a lot of them sold. And now they're continuing. And what I wanted to see was whether we would have a cup and handle. And right now, it looks like it's a little too deep to be a handle anymore. So if it goes down here to this 200-day, and you can see pretty clearly where the 200 and the 50 meet right there, that's probably where it's going to, around 205. I think that area is a little too deep to call it a handle, but we'll see how it acts once it gets there. If it starts to climb back up again, then this level of 260, if this happens over the summer, and in October, the market starts to rally into the election and after, till the end of the year, which is what it normally does during election years, then Tesla may actually be able to break through that. But right now, it doesn't look very good. Not a very good look for Tesla at this point. Netflix had earnings back here. Again, the numbers were pretty good, but the guidance was not great. So initially, it rallied, and then the rest of the day, it sold off. But it's been hanging in there right about the lows where it sold off to. So we'll see if Netflix can stop going down. AMD is a really bad look for AMD. So AMD had a short-term down right here. You can see the momentum crossed over right here on this candle. All of these right here. In fact, if I put a vertical line in on this, you'll see right there. So that's where the actual cross happened. If we go back to this one right here, you can see that this one was getting ready to cross, but it actually crossed here, and then I got a short-term signal the next day. So it kind of gave you some warning that this was coming on AMD. And AMD actually doesn't have a good look at all. It's below its 200-day right now. So it just got a medium-term down signal today. If this red line gets down here to the 200-day at 155, it's going to give a long-term down signal also, which hasn't happened for quite a long time. If we go back, further back on AMD, you can see right here, it's sitting right now right on a very long-term support line right here. And just a little bit below that, right about there at 132, is an even bigger support line. So right now it's at 144. If it goes down and breaks 132, then could easily get back down here to 100 or lower. So AMD, it does not look good right now. We have to keep an eye on that if anybody is interested. If you want to buy AMD, I mean, it might be a good time to buy it at some point, but I wouldn't be catching a falling knife. Right now is not the time. And that's the thing about when you get sell-offs like this, a lot of people think that it's time to jump in, but it's not quite time yet. Actually want to wait for it to prove that it's starting to move back up. SMCI also sitting right down here on a support line. If it breaks through that, it's going to go to the 200. And then which is at 650. And if it doesn't hold there, then it could go quite a bit lower from there. So 650 is the key for SMCI. Here's Oracle. Oracle hung in there pretty well, actually. Yesterday, it was starting to move higher. And I was wondering about Oracle because it looked pretty strong yesterday. Of course, it sold off with the market today, but it's still above its support lines, and it's got this big gap open from earnings. So I think it's going to probably hold right there, and this 50-day moving average is going to come up to that gap support too. So Oracle actually looks pretty good, as does Palantir. Now, Palantir sold off pretty heavily today as well, but along with the rest of the market, as the market was starting to sell off, Palantir actually hung in there. So this is one, if you're looking to add or get into Palantir, you might get an opportunity pretty soon. That opportunity is not right now. All right, so that's it. So that's all the Magnificent Seven. Last thing I'll show you over here is something that I watch, and this is something that will help identify a bottom. I'm thinking of actually creating a chart that's call it the bottom finder chart. But the 50 and 200-day analysis right here. This shows you the percentage of stocks, and we're looking at the S&P here. Percentage of stocks above their 20-day moving average, 50-day moving average, and 200-day moving average. And what you can see on the 20-day, 59% are above their 20-day. That's still pretty healthy. On the 50-day, 59%, 59.2%. So that's 59 stocks, I'm sorry, this is 500 stocks, but it's 59%. And then on the 200-day, it's still pretty good. It's got 72% are above their 200-day. So even though things look dire, and you can look at the chart, the S&P chart right here, you can see it's sitting right on the 50-day moving average. If it breaks through that, that's a key support level. I mean, it could easily continue to go lower, but these are the things that I'm watching. So you can see back here in April, when we had that big sell-off in April, see what happened with the 20, the 50, and the 200-day down here. Especially the 20-day, it came all the way down here to, I think it was about 8%. And the 50-day was at about 28%. So that's usually when bottoms form. Whenever you get a big sell-off like that, and you get stocks, that percentage of their 50 and 20 and 50-day moving average is that low, that's usually when we're getting close to a bottom. There's some other ways to identify a bottom too, which I'll talk about if we start to get down there and start watching for that bottom. You can also do the same thing on the NASDAQ 100. So here's the NASDAQ, which is actually sold off even harder. You can see that 26% are above the 20-day, 37% above the 50-day, and 62% above the 200-day. So it's getting down there. 37% is, less than 50. So this is the NASDAQ 100. That means only 37 stocks are above their 50-day moving average, and only 26 stocks are above their 20-day moving average. It's still not as low as it was back here when we got to this low in April. So that's what we want to watch. And I'll bring this up in the next few sessions that I do with Zuber and on my own. We'll look at this again, and we'll see if the market continues to go down, how this one looks, because this is going to give us the advance warning of when the bottom is in, right there. So keep an eye on that one. Another one to watch is the trend analysis. So NASDAQ 100, you can see the NASDAQ 100 is still in a bullish long-term trend, a bullish medium-term trend, and a just turned bearish on the short term. So the medium-term and long-term are still hanging in there. So the market still has to come down quite a bit. So the NASDAQ 100 is sitting right on its 21-day. This is a weekly chart, so the 21-week moving average. And if it drops below that, then the 50 is down below. And that's what we went down to back in October when we hit the October low. And notice this is the July to October period right through here. I think this is going to be similar. So I think we will probably come down to this level again, just like we did last July, before we start to head higher. So that's where we are. Keep an eye on all this. By the way, for those watching the market timing strategy, I sent out an alert to subscribers today that this just gave a go to cash signal. And actually, for those that want to play, this could be short term, but those that want to play the inverse ETFs, that gave a long signal today also. So if we look at the total market index, you can see it broke through its 5-day moving average. It's this very light gray line right here. That's the first signal to go to cash when it goes through the 5-week. Sorry, this is a weekly chart. The 5-week moving average. If you want to stay in for the longer term, like during this period right here in April, it never went through the 21-week. So you could wait for that too. Just that I would prefer to sit it out. And if it does come back like it did here, then you'll have a chance to get back in again. But if it doesn't, if it continues lower like it did back here last July, then I would rather be sitting on the sidelines or in an inverse ETF. And then with the understanding that it could be short term, that we may get right back in the next couple of weeks if the market turns around. We'll see. But right now it's a go to cash signal, just to be cautious and prudent. And I think that's always an important thing to do. If you wanted to look at the 3X inverse ETFs, so QID is the inverse 2X inverse down here. You can look at the daily, and you can see right here how this is, all of the momentum indicators have already triggered basically, and this is starting to take off. It's now above its 50-day moving average. So that's why this gave a long signal on this particular one, QID or SQQQ, either one. SQQQ is the triple 3X. This is the 2X. But they look the same. So I can just type in SQQQ right there. You can see it looks identical. This will give you a 3X return as it moves higher. But you want to be careful because if the market does reverse and starts to go higher, this is going to go lower. It'll be 3x the other way too. So just keep that in mind. Not something that you want to necessarily play for the long term, but if we are in a down market until October, could make some nice revenue between now and then. All right, that's it for now. Be careful. I think the market is still going to continue to go down. By the way, I mentioned banks, and I set up these dividend portfolios over here. Every year, in the beginning of the year, I do this. I do searches for the dividend aristocrats. I'll post the results at the end of each month. So we're not there yet, but I'm going to show them to you. And this explains, what they are. This is the VectorVest scan for dividend stocks. It was up about 1% last month. This one was up 7.5% last month. And then I created my own scan using some very strict criteria. But interestingly, this was that in January, remember. Interestingly, most of the stocks that ended up in the scan were banks, regional banks and large banks. So it was up 5% at the end of June. And we can take a look at where it is right now. Right now, my scan is up 12.8%. The VectorVest is up 4%, and Dividend Aristocrats is up 10%. So mine has taken a little bit of time to start to catch up, but it's actually starting to perform really well. And you can see what it did last year, up 25% last year. This does not include dividends, by the way. This is just the equity. So these scans actually work pretty well. They're designed just to buy them on the first day of the year and just hold it. Don't do anything. Don't trade it or anything. Just hold it all the way through the year. So we'll see how it turns out. All right. Thanks, everyone. I appreciate it. If anyone would like the newsletter, just go to breakpointtrading.net. If you like the idea of the trend models, you can become a subscriber, either monthly or annual subscriber, and you'll be able to see those changes as they happen each day. This is the type of thing I do at the end of the day after the market closes. I don't really have to worry about it during the day, and it helps me understand what my plan is going to be moving forward. So be sure to set stops. Oh, speaking of which, let me show you one thing. Show you a stock that I bought a couple of weeks ago. Bausch and Lomb. Pretty ugly chart right there. So I'm not sure what the news was, but they did not even report today. So I bought it back here somewhere, and it started to move up. I moved my stop up to break even. It moved up here. I think I bought it at about 650, 625, I think. So I moved up here, and I moved my stop up. Last week, I moved it up to 7.25. And I got a notice today that it executed, got stopped out at 723. And I didn't really think much of it. I'm like, okay, that's what I wanted. It did what it was supposed to do. But then when I looked at it, and it looked even worse earlier, you can see how far down it went. I mean, this thing sold off all the way down to $4, way down here. But just having that stop in saved me all of that pain. Down 23% today. It was down probably 50% at one point, more than 50%. It was probably down 60% at one point today. But just by having my stop in right there at 725, and I put a stop in as soon as I buy something. Having that in right there, I didn't have to worry about it. It automatically executed. This one did not gap down. It just sold off all day long. So as soon as it hit my stop, it executed, and I was out with a profit. So I made money on this, even though it went down more than 60% today. So that's a testimony for having stops. Very, very important. And there's lots of ways to do it. I've taught that here on this channel a few times. And I've got some things on my website that can help you understand stops and how to set them. But I cannot tell you the number of times that this has really saved me by having stops in on stocks that I bought. All right. So that's it for today. Thanks, everyone, for watching, and talk to you on Sunday. Take care.